The US Fed and the Bank of Japan, big policy statements this week. What did you make of both of the statements from Kuroda and then from Janet Yellen?
Yeah, firstly, Kuroda's tweaked the curve, trying to steepen the curve. Purely, I think, a cosmetic change. There's still some issues there. They're trying to get inflation up towards 2%, but as we know, it's still at around negative 0.5%. So we're a long way away from that 2% target that the BOJ is aiming for, and I very much well doubt that we can see inflation aided by that steepening of the curve. Having said that, dollar yen seems to be holding around this support level at 100. I'm a little bit agnostic as to where it goes from here, but at the moment she's holding. Moving on to the Fed has come and gone. I think probably now until December it's out of play. We have the election coming up in early November, and I think what that means for markets is we have a sweet spot for risk assets. Basically, we'll start to see riskier assets perform well into late October before that election. Now, how that translates into the currencies, I think we're going to see commodity and risk currencies rally, things like Aussie and dollar CAD. And when I look at the Aussie chart, which we've discussed previously, Aussie has been constrained by some very decent tech resistance on the top side, coming in at the moment around 76.70, 76.80, and on the downside there's very good support around 77.40, 77.50. So what we've had is the Aussie trading in a range, respecting these technical levels, but clearly that can't continue indefinitely. Now, my preferred view for the Aussie is that we continue to see the Aussie push towards the top of that trend line, and I think what we should be looking to do is buy the Aussie on a closing break above 76.80. Now, should that occur, I only want to be a buyer. Should that occur, we then should see the next leg of the Aussie rally eventuate up towards 80 cents. Conversely, the Aussie holds that resistance 76.80, which you should be seeing quite clearly there on the charts, and breaks below 77.50, 77.40 odd, then we could start to see the Aussie push back down below 70 cents. So it's a little bit of a wait and see proposition for me at the moment, but when the break does come, I think you've got to be ready to go for it, and I've outlined those levels that I'm watching for you.
Okay, so we're a preferred buyer of the Aussie at this stage. What about the US dollar against the Canadian dollar? I note here that your next big move potentially to the downside.
That's correct, yeah. Dollar CAD's been consolidating for the better part of this year within a range, I guess 125 up towards 132.50-ish. Now, I've got a very bullish wave count on crude oil, so it's not quite there yet, but a very potentially bullish wave count on crude oil. And CAD and crude are very well correlated. Obviously, oil is one of the biggest exports of Canada. So what I'm looking to do there in dollar CAD is to sell dollar CAD on a bounce back towards 131. I'd like to put a stop loss above the top of the recent range, which is around 132.60 area. And should my view of the dollar softening and also crude continuing to rally play out as expected, I think you'll see dollar CAD trade towards 125, which is probably the lows for the year.
Help the viewers understand the significant correlation with oil and the Canadian dollar, because it's a little bit like commodities here in Australia with iron ore. With the Aussie dollar, oil's very closely aligned to the Canadian dollar, isn't it?
Yeah, absolutely. We always look for correlations as traders and salespeople in markets and anything which can give us a bit of an edge. And I think it's well known that Aussie has traditionally been very well correlated with things like iron ore. Previously it was copper. Canada, much the same. Oil, a huge export of theirs. And as such, the fortunes of the currency and indeed the economy are closely aligned to where the oil price goes. Now, if you recall, we've seen a very, very sharp sell-off in crude oil, where we've been down to as low as $28. Currently we're sitting around $45, $46. I think potentially crude oil can push up into the low 50s. If that happens, I think it can open up a clean break up towards maybe $70 or $80 per barrel. So that should be very, very supportive of the CAD going forward. Once again, we're a little bit wait and see to how this plays out, but like all sorts of sports or traders, we like to have a plan, and the plan has to be implemented when the criteria is right, and we're watching with eager eyes at the moment to implement those plans.
Okay, so US dollar, Canadian dollar, next move to the downside. All right, our next chart we're going to look at here is the Aussie dollar against the Kiwi across the Tasman. And this one, we're looking for longs on the Aussie dollar.
Yeah, for the time being, the party balloons and the hats have been put away in New Zealand. They had been, I think, hopeful of a test of parity, but we've seen momentum wane to the downside in Aussie Kiwi, and that was even before the RBNZ meeting, which came out earlier this week. But the RBNZ were quick to highlight they preferred to see a lower currency. As well, they were expecting further easing. So that's weighed on the Kiwi and I guess given us a decent bounce in Aussie Kiwi up towards 104.50 area. There is some very good technical resistance coming in around 105, 105.50. Should Aussie Kiwi continue its rally that we've seen for the latter part of this week and trade above 105, 105.50, I think that can generate a very nice buy signal targeting 108 initially and then possibly as high as 114. So that's been the preferred trade and the way the market wants to play this currency pair. It just hasn't worked out as yet this year. Maybe into the end of 2016 we can see Aussie Kiwi start to push up towards those at least 108, 110 area.
Graham Wheeler noted this week that he expects to drop rates again at some point this year. Is that mostly now been priced into the market, and any further comments from him is likely to not have any significant impact in the moment that he releases those statements?
Yeah, it has been priced. Currently, an easing is priced in November. About 70% the market has priced. So there's definitely more room to move if they do fulfil that idea, and also the CBA forecast for another interest rate cut in November. So there is room to move. Perhaps with so much priced in, it won't be as big as it would have been if it was a surprise move. But the RBNZ have been on had an easing bias for a while. They have cut interest rates this year. So the market is prepared to, I guess, give them the benefit of the doubt and wait to see. They want to see the colour of their money. They want to see the RBNZ cut. And should that happen, Kiwi takes another leg lower, Aussie Kiwi takes another leg higher. Of course, the other part of the equation for Aussie Kiwi is the Aussie component, and we have the RBA, I think, potentially in play in early November. Much less probability, though. And if RBNZ cuts, RBA stays on hold, that is also another catalyst for Aussie Kiwi to move higher.
Okay, so Aussie Kiwi looking for a long there. Now let's have a look at the euro and the sterling. On this one, we're looking at a potential head and shoulders formation here.
Yeah, certainly on the short-term manager, euro sterling has had a very sharp rally since Brexit, as indeed sterling has sold off against the US dollar. But since that initial move, we've seen euro sterling consolidate in a bit of a range. Now, the head and shoulders top that you mentioned comes in around 86.30, and so far we have respected those levels, and they should indeed be respected in the short term. So short-term traders may like to take a short in euro sterling. Current levels, I think, around 85.70 with a stop above 86.30, 86.40 area. My preference is to be a buyer of euro sterling because I think Brexit, although the market has discounted a little bit of the short-term impact of Brexit, there's still some medium-term implications that need to be played out in that stage. The other thing, of course, is the UK data has been very strong or much stronger than expected post-Brexit. And, of course, part of that is because the currency has had a sufficient or a large shift lower post-Brexit. So things are doing better in the UK, but do they stay on that trajectory into a year end? I very much will doubt it. So looking to be a buyer of euro sterling on a medium term basis, either on a dip down towards 83, 82.50 or on a break of that head and shoulders top. So I guess there's something for both types of, for people with both views of euro sterling. If you prefer to be a seller, you've got a very clear stop above the head and shoulders top. And if you're like me, a little bit more bullish euro sterling medium term, you can look to be a buyer on the dip or wait for that head and shoulders pattern to break.